Hello and welcome to Business Today Television. I am Siddharth Zarabi and you're watching Easynomics. On the latest IIP data that's come in for the month of September, India's industrial production has hit a 3-month high of 3.1% after a contraction of 0.7% in August. This is the data that's been released by the National Statistical Office. The rise has largely been powered by a 11.6% increase in electricity generation in the month of September, which is up from 1.4% a month ago. And joining me to decode what this data means, which is slightly above estimates of various economists, is Indranil Pan, the chief economist at Yes Bank. Indranil, welcome to BTTV. The IIP numbers in terms of the headline 3.1%, what do you make of this number?
I just heard your initial comments on the data. Yes, you are right that this number is higher than most of the expectations that the economists on the street had. For example, we had a 1.9% increase. But having said that, I think the one thing that I need to point out, and that might bust a bit of the upswing that we are seeing, is that the electricity is 11.6% YOY growth. Having said that, the index for electricity, what I see, has actually dropped from the August level, but the 11.6 is because of a huge base effect from the previous year. Consequently, on the other side, if I look at the other elements like the manufacturing growth has been just at a 1.8%. The other sort of note of caution is the revision that has happened for August from a positive 0.8 to a negative 0.7. And that's not a very sort of sweet music to the year, is what I would like to put out. Anyways, September number was expected to be relatively higher because of the restocking that is supposed to have happened for the festive month in October.
Indranil, we'll get into various segmental data, but in terms of the half-year performance, counting from the month of April, growth in industrial production is at 7% against close to 24% last year, if I recall that number correctly. What does that indicate in the broader sort of over a 2-quarter timeline?
Well, I think, yes, definitely the index is improving, production is coming back. But let's note that the data for 2021 similar period would have been on a very low base of the 2020, which was mostly hit by the COVID wave. And therefore, a lot of activity was not really happening. And that's the reason you see April to September 2021 being at 24%. Having said that, I think the trajectory definitely looks to be on an improving scale. If I look at more advanced indicators like the PMI, etc., that looks to be relatively on the expansion zone. But again, a word of caution, IIP may not be indicating the whole gamut of the economic strength versus the weakness. There can be some elements of weakness that really come to my mind. For example, the freight traffic has not really picked up in a very significant way. But we will have to see how post-festive season the demand emerges and how the production cycle pans out, given the fact that we have continued to see sticky inflation and also increase in the interest rates by the Reserve Bank of India.
That's a good point on post-festive season, and whenever we discuss the numbers of the actual festive season, which is the month of October really, the 3 weeks prior to Diwali, we saw anecdotally all across our markets a significant amount of consumption happening, although that would be restricted to certain areas. Now let's do a quick segmental deep dive into the latest data. The mining sector growth in the month of September, all these numbers, viewers, that I'm going to share with you are September month numbers, 4.6% versus 8.6%. The comparison in all data that I'm giving you is obviously on a year-on-year basis. Manufacturing at 1.8 versus 4.3. Electricity, like we just touched upon, 11.6 versus 0.9, and Indranil pointed out a very important element there. Primary goods 9.3% versus 4.6. Capital goods 10.3 versus 3.3. So obviously, primary goods and capital goods output, there is a quick, there's been a good bump up, but that bump up also on account of the fact that, like Indranil pointed out, it was perhaps in anticipation of more consumption. Intermediate goods, however, at 2 versus 7%, a clear decline. Infrastructure goods at 7.4% versus 9.3. Consumer durables at a negative 4.5 versus 1.6%. Consumer non-durables at negative minus 7.1 versus 0.1. That too was negative. And the August revision was revised downwards to negative 0.7% versus a negative 0.8. So let's leave that aside. Out of this, if we take manufacturing to start with, Indranil, why is manufacturing growth down in the month that we are discussing?
Well, to a certain extent, sort of rather than looking at the manufacturing as a perspective, I think it is possibly better to look at the used base side and figure out what is
Okay.
happening within the manufacturing sector.
Yep.
The positive sign that I see in the data is that the capital goods has been picking up, which is a very positive sign, and therefore you see a 10.3% growth in September compared to 3.3 in the September of last year, which to a certain extent indicates that there could be some amount of investment demand that is picking up both from the government side and the private side. Having said that, I think the consumer durables is continuing to be a bit of a worry with a negative 4.5%. And within the consumer durables, and especially as we are talking about the festive season, I think the hit has been relatively more on the rural consumption. That is something that we really need to look at. Now, data that came out today, even in terms of the CM data on the automobiles, did continue to show a pickup in the passenger vehicles, whereas the two-wheelers has not been doing quite good. That continues to be the case. So the point being made is that it is still a very segmental sort of divergent growth that we see if we compare between the rural segment and the urban segment. And that is something that really sort of needs to be kept in mind as we try to figure out what the growth trajectory for India would be in the near future. More importantly, because of the higher inflation and the interest rates. Now, just one last point is given the fact that inflation in most of the food commodities has been higher, to a certain extent, we might be dulled into thinking that it is favoring the farmers. But most of the farmers in India are subsistence farmers, which necessarily means that their real income is likely getting affected, and that could also impact even consumption of essentials from the rural segment.
Viewers, remember that manufacturing constitutes over 3/4 of the total weight of the index of industrial production. So that's the most crucial component. There are some other elements that we can see from here. Mining did well, and this could have been also on account of exports and a pickup in domestic demand. Infrastructure growth and many of the projects, Indranil, that are working, I think that support has also been seen in the numbers. There is a positive element as far as the auto sector is concerned. Textiles doesn't seem to be doing too well. I think that could be on account of lower export performance. And what are the other sort of specific granular highlights that you would like to tell our viewers about?
But sort of, I know, I understand where you are looking at, and there are certain sort of both positive signs and negative signs. So if I am going to sort of distribute the the segment wise or the 2-digit industry code that I look at. But having said that, I think certain elements which look to be positive to me at this point in time are the basic metals. Even the sort of smaller items like computer electronics and optical products are doing well. That's possibly in terms of the PLI schemes that are operating, and we all know that mobile production has continued to pick up. On the other hand, if I look at some of the negative elements, you've already pointed out to the manufacturing of textiles, which continues to be a negative of 12% so far in September 22. Which even is reflected in the manufacturing of wearing apparel, leather and leather products. So some of this will also, to a certain extent, and as you rightly pointed out, may be due to lower exports because of the fall in demand in, especially I think Europe, and also to a certain extent in the US. So that could actually be leading to the lower growth sort of push in some of these sectors.
Indranil, you touched upon that point, and let's now look ahead. If one were to describe the past 6 months in terms of our domestic economic performance, we could perhaps say largely stable, but with dark clouds of inflation. These are my words. I don't know if you agree or disagree with me. The remaining 6 months, given what is happening internationally, do you expect the momentum of growth in India to at least remain stable?
Well, if I sort of look at H1 versus the H2, given base effects of the previous year, H1 obviously is looking more robust than the H2. But if I move away from the sort of base effect factors, I think the critical drags for the economy at this point in time is the net trade. Exports have been crumbling while imports have been relatively more stable. So that's one worry for the GDP numbers. Private investment demand has possibly not been picking up the way one would have expected it to pick up. So that's the other sort of critical factor that we would want to look at. And on the other hand, I think the private consumption demand is something that can suffer because of the lower sort of expenditures due to the higher interest rates. So the only factor that stands out is the government expenditure. And if the government is able to find out adequate funds, which they should be able to, given the higher tax collections, we should be ending the year closer to a 6.9 to 7% growth, where I think most of the median estimates are gravitating to.
The number that you gave us of full year growth, GDP growth, and I'm going to recap it for our viewers. What Indranil Pan, the chief economist of Yes Bank, has just told us, that he is working with a number of 6.9 to 7% GDP growth in FY23. Is this the number that you had started the year with, or have you had occasion to revise it upwards or downwards?
So, very honestly, this time we were relatively more cautious in terms of our GDP numbers because we were seeing this very unequal growth, which I even alluded to earlier. The segment, the rural versus the urban, the people who were relatively more affected by the COVID versus people who were not relatively affected by the COVID. So therefore, we were looking at slightly sort of a cautious atmosphere in terms of the growth, and our initial print was 7.2%. And after the first quarter number came out, which was relatively lower than what the median estimates were, we revised our number down from a 7.2 to a 6.9. So that's where we are. Unlike some of the other sort of agencies who had marked growth above 7.5%, and now they are having to revise it lower. Having said that, I think even 6.9% to me may have a slight downward bias, given the extent of monetary tightening that needs to be seen in the days and the months ahead.
As we wind down this conversation, I just want to pick up two quick points with you. One is, what is your own sense about domestic inflation? And before you answer that, I want to tell our viewers about something that we've been raising since the US reported lower than expected inflation numbers, and the pivot that it seems is now underway in China from their very strict zero COVID to a more relaxed kind of environment which has its own dynamics, and there was a clear impact as far as global markets are concerned. And the Indian markets also today closed significantly up, perhaps celebrating that, because you could see a reversal of what has been happening for the past few months. But in that euphoria in the markets, the core concern around Indian inflation still remains, and what the MPC might choose to do in the next meeting. How is domestic inflation, according to you, going to pan out over the next 2-3 months?
As per our models, after the 7.4% that we saw in the last reading, we are likely to see a 6.8 to 6.9%, with the critical risk coming from vegetables, which we think will probably wind down due to the seasonal factors. Some of the critical strains continue to be on the food side, including cereal prices, where the global sort of short supply could have its implication for prices. A bit of a worry remains on the core side also. But having said that, if I were to look at the headline number, which the RBI also would be looking at, 6%, sub 6% is only in accordance to us, is possible in February 2023, which necessarily means that irrespective of a 75 turning to a 50 by the US Fed, we continue to expect the RBI to do a 50 in December, and followed by a 25 to 35 in Feb, where they would possibly be willing to pause and take a hard look at the inflation versus growth metric, and then sort of decide what to do.
That's actually quite an important observation that you make, because one would argue, and Indranil, I know you might agree with me, that vegetable inflation should not perhaps influence monetary action so directly in a economy of the kind that we have in India. But like you said, core inflation is also a concern. A final point, would I be in an absolute minority to even dream to think that the RBI may choose to pause?
See, I think in the current sort of uncertainties that we have, and every central bank would have to pause at some stage in time. They can't go on continuously increasing interest rates, and that I think is very clear from even the last communication that we heard from the Reserve Bank of India's Shaktikanta Das. Now, having said that, I think definitely December is not a period when we are looking at a pause. At best, if I were wrong, the pace of increase may be lower than the 50 that I just pointed out. But I am still expecting a pause to happen in February. RBI might not be willing to let its guard down unless they have confidently seen inflation below the 6% threshold.
Well, even February, a pause in February would be cause to celebrate, in the deal, and because the growth needs that our economy has and the impact that interest rate hike have as far as an economy is concerned, and especially the lag with which the transmission happens. Indranil Pan, it's been wonderful talking to you as you decoded with such great patience the latest IIP numbers. The headline, as I leave you viewers, is that the industrial production seems to be on a trajectory where it is likely to remain stable. Inflation is a key concern, but growth forecasts are already gradually getting moderated. So the next half of the year, the remaining months of the financial year in India are going to be key to watch out for. But the big action, which lies a few months away, is the union budget on the 1st of February. With that, it's a wrap on Easynomics this Friday on Business Today television. I'm going to wish you a good weekend. We'll see you again on Monday. Till then, goodbye.